RateScope here. Let me tell you about the most audacious market manipulation in modern commodity history, something that happened right under our noses in late 2025 and early 2026. What I'm about to share with you isn't conspiracy theory. It's documented intervention by two of the world's most powerful financial institutions, the CME Group in the United States and the Ministry of Commerce in China, working in tandem to hijack the silver market at the exact moment it was poised to expose the biggest fraud in the precious metals space. Silver was the best performing asset of 2025, delivering a staggering 147% return. It outperformed Bitcoin, crushed the stock market, and left gold in the dust. By December 2025, silver reached an intraday peak of $83.62 per ounce, driven by absolutely inelastic demand from the photovoltaic solar sector and AI infrastructure. This wasn't speculative mania, it was real industrial demand colliding with 5 consecutive years of structural deficits, where consumption consistently outpaced mine production. That's when the CME Group decided to pull what traders now call the kill switch. On December 26, 2025, CME issued advisory number 25-393, raising the initial margin for March 2026 silver contracts from $22,000 to $25,000. When momentum continued despite the first hike, CME delivered a second massive 30% increase on December 30th, pushing the requirement to roughly $32,500 per contract. This 1-2 punch effectively raised the cost of holding a silver futures contract by nearly 50% in a single week. The resulting New Year's Eve liquidation saw silver dive from around $80 to an intraday low of $71.23, as thin holiday liquidity amplified forced margin call selling. At $75 per ounce, a standard 5,000-ounce COMEX contract has a notional value of roughly $375,000, about 15-to-1 leverage against a $25,000 margin. When that margin jumps to $32,500, over-leveraged traders are given hours to post additional cash or face immediate liquidation. Here's the key. This mechanism primarily protects clearing members, the very bullion banks that often hold large short positions. The legal foundation sits in CME Rule 802, which gives the board the absolute right to change margin requirements at any time without prior notice. The exchange defends these moves as risk management. In practice, this was the beginning of what I call the Great Divorce of 2026. The point where the paper price on COMEX detached from physical reality in the East. While Western exchanges throttled volatility with financial mechanics, China implemented something much more fundamental. On January 1, 2026, the Chinese Ministry of Commerce enacted a new export licensing regime for refined silver, elevating the metal from an ordinary commodity to a strategic material on par with rare earths. This effectively weaponized silver supply at the exact moment the global market entered its 5th straight year of structural deficit. Under the new rules, only 44 state-approved companies are allowed to export silver for 2026-2027. To qualify, firms must have annual production capacity of at least 80 tons of refined silver, verified credit lines over $30 million, strict dual-use licensing with government authorization for every single export permit. This policy culled hundreds of small and mid-sized refiners that had been key suppliers to Western industrial users. By concentrating export power into 44 state-aligned entities, Beijing secured significant pricing power and the ability to prioritize domestic industries, solar, EVs, electronics, over foreign competitors. Administrative bottlenecks pushed retail delivery windows for silver out to 12 to 16 weeks in early 2026, up from 2 to 4 weeks in prior years. The timing coincides with the U.S. officially adding silver to its critical minerals list in 2025, recognizing its irreplaceable role in defense electronics, missile guidance, and Green New Deal infrastructure. Silver became a front line in the resource competition between the Trump administration and Beijing. By mid-January 2026, the divergence between the COMEX paper market and the Shanghai physical market was extreme. While COMEX paper prices were being pushed down towards $70 per ounce during the week of January 9th, physical silver in Shanghai traded around $130 per ounce, roughly a 40% premium. That's a screaming signal of severe market stress. You might ask, why doesn't arbitrage close that gap? In theory, traders should buy cheap silver in New York and sell high in Shanghai. In practice, arbitrage broke due to structural barriers. Different bar standards. Shanghai requires 99.99% purity, 15 kilogram bars. COMEX accepts 99.9% purity, 1,000 ounce bars. Refining COMEX bars up to Shanghai standards is costly, and refineries are already at 100% capacity. Capital controls and export restrictions. Strict Chinese rules and export licenses make moving silver in and out of China slow and difficult. Licensing choke points. Even if you have metal, getting it cleared through Chinese bureaucracy is slow, unpredictable, and politically sensitive. Meanwhile, the paper-to-physical ratio, futures exposure versus actual metal in vaults, was exploding. Historical estimates already suggested 250 to 356 paper claims per physical ounce. In January 2026, the March futures contract alone represented about 528 million ounces, against just 113 million ounces of registered silver in COMEX vaults. If even a fraction of contract holders demanded physical delivery, the system would face an immediate force majeure or cash settlement event. The exchange simply cannot deliver that metal. They'd have to pay you cash instead. But if physical is $130 and they cash settle based on a paper price of around $71.50, you've just been robbed of the difference. That is the core of this game. Both Western and Asian vaults have been drawing down metal at a historic pace. In the first week of December 2025, about 47.6 million ounces were claimed from COMEX warehouses in just 4 days, representing 60% of the available registered inventory. The market entered deep backwardation, where spot trades significantly above futures, a sign of desperate demand for metal now, not later. On the Shanghai Futures Exchange, silver stocks fell to about 455 tons by January 30th, 2026, down from an all-time high around 3,000 plus tons in 2021. That shows the physical drain is global, leaving both major hubs with dangerously low coverage. The culmination came on Friday, January 30th, 2026, the largest single-day percentage decline in silver since 1980. In just 48 hours, silver crashed from above $121 to settle around $78.53, a 31.4% decline. The crash was triggered by a perfect storm, the Warsh nomination. President Trump announced his intention to nominate Kevin Warsh, a perceived monetary hawk, as the next Fed chair. Markets immediately repriced for higher for longer rates, boosting the dollar and hitting metals. Reuters fake news panic. An exclusive Reuters piece claimed the U.S. government was ending all support for strategic metals programs. The Energy Department later called it false and misinformed, but by then algos had already dumped. Month-end liquidation and gamma squeeze. Thin liquidity near month-end created a classic gamma squeeze. Options dealers sold futures to hedge, accelerating the downward spiral. Over $3 trillion in market value was erased from gold and silver in minutes. The ProShares Ultra Silver ETF plunged 62% in a single session. Despite this paper massacre, the physical shortage was not fixed. If anything, it became clearer. Volatility reignited debate over manipulation by major bullion banks. Regulators have already found significant evidence of spoofing and price rigging, leading to about $1.26 billion in fines against 8 major banks between 2016 and 2025, including JP Morgan's $920 million fine in 2020 for spoofing between 2008 to 2016, which sent 2 traders to federal prison in 2023. Critics argue the 2026 CME margin hikes are simply a new iteration of the same system, designed to protect the house when they're caught on the wrong side of a rally. By late 2025, JP Morgan had reportedly flipped net long, holding an estimated 713 million ounces of silver across its accounts, while other banks remained trapped short. The hijacking has profound implications for the U.S. economy, especially the solar and EV sectors. Solar requires roughly 10 to 15 grams of silver per kilowatt of capacity. In 2026, global solar capacity is forecast near 665 gigawatts, consuming 120 to 125 million ounces. China's export squeeze and anticipated price surges of 30 to 40% threaten the cost structure of the entire green energy push. Elon Musk raised the alarm in December 2025, saying silver is crucial to many industrial processes, and that Chinese export licensing was not good. EVs use 25 to 50 grams of silver per vehicle, nearly double that of traditional cars. Unlike gold, silver is mostly a byproduct. Over 70% of silver supply depends on copper, zinc, and lead mining. Even if silver doubles, miners cannot significantly boost output if base metal demand is flat. With 10-year lead times for new mines, the global silver deficit is essentially math destiny, not easily fixed by price alone. Despite the January crash, the long-term technical structure remains bullish. Analysts outline two main scenarios. Bullish case: silver in the $85–$110 range if China enforces restrictions, but alternative supply fills some gaps. Super bullish case: silver in the $125–$150 range if COMEX faces a true stress event, physical collapses, and paper-to-physical pricing finally breaks. The gold-to-silver ratio has compressed toward 45:1 in early 2026, its lowest level since 2011. Historically, silver outperforms gold in the late stages of a bull market. Even with gold stable, further compression toward its long-term median of 50 to 60 easily supports triple-digit silver. The events of 2025-2026 mark the end of the era of cheap leverage in silver. By raising margins to historic levels, CME signaled it will not tolerate the meme stock-style retail surge that fueled the 2025 rally. But this crackdown on leverage does nothing to solve the underlying physical shortage. We now have a bifurcated world: silver as a financial derivative, silver as a strategic industrial metal. If physical drain from COMEX vaults continues at the current pace, the exchange may be forced into force majeure, effectively breaking the promise that a futures contract is as good as metal. For investors and industrial users in the US, the Great Divorce suggests the only way to avoid kill-switch volatility is owning unencumbered physical metal, or using vehicles like Sprott's Physical Silver Trust that hold audited bars. Manufacturers must secure long-term offtake agreements with non-Chinese producers, even at 8 to 12% premiums. Leverage traders should assume any major rally will be met with another margin hike. Ultimately, this silver hijack is a microcosm of a bigger geopolitical shift. As U.S. debt pushes toward $50 trillion and de-dollarization accelerates, central banks increasingly treat gold and silver as ultimate hard asset hedges. China's export restrictions aren't just about industrial supply, they're about controlling a strategic reserve asset that gains importance as the global financial order is rebalanced. What we've witnessed is not a normal correction. It's a coordinated intervention by the two most powerful players in the global silver market to prevent full exposure of a fractional reserve system that has existed for decades. The only real question now is, how long can they maintain this control before physical reality overwhelms the paper illusion entirely?